Hello, and welcome to the Fiduciary Pension Partners monthly plan sponsor webinar. Today, we will be talking about employee stock option programs and building a foundation for the future. Again, just a quick reminder, Fiduciary Pension Partners, we are an independent pension consulting firm assisting you with things like outsourced CIO for your foundation, endowment, or retirement account, risk mitigation and plan design, fiduciary governance, committee training, and employee financial wellness. Today, we will have with us Ashley Sorokin, Managing Director of Lazier Capital. Ashley,
Thanks, Steve.
It's your
Appreciate
presentation.
it. Thank you so much. Quickly, just a little bit about Lazier before we get into the ESOP 101 presentation. Lazier is a boutique investment bank. We work on sell-side engagements exclusively, and ESOPs are our specialty. Founded in 1999, we've worked with middle market companies, sales ranging from 25 million through 3 billion. So what is an ESOP? These three main bullets will describe the ESOP. First of all, an ownership transition tool. So a selling shareholder, this is a stock sale. They are selling their shares to an ESOP trust, which is a qualified retirement plan. So in this retirement plan, similar to a 401k, that you may or may not have a contribution from your employer that would match whatever that you're putting into your plan. This is a free benefit that you would receive shares, and the difference, not only it being free to you as an employee within a ESOP, these shares, instead of being invested in a diversified portfolio of stocks and bonds, the benefit would be tied directly to the company that you're working for, the ESOP company. These benefits to the shareholders, they exist through programs in Congress, and the main two would be the fact that as you sell an ESOP or sell to an ESOP, the seller would not pay capital gains taxes. So on an ordinary transaction, after paying those capital gains, depending on the state that you reside, the proceeds would be about a third more if you're selling to an ESOP and not paying the capital gains. The other very significant benefit is that post-transaction, a 100% ESOP-owned company does not pay federal or state income taxes as well. And this very largely helps with the company's ability to pay the selling shareholder and also its employees. Really quick, just to really hit this point home, an example, and again, depending on the state that you live in, the capital gains tax would change, but you would have to sell to a third party for about 33% more on average to have the same proceeds as you would selling to an ESOP. So why does Congress encourage ESOPs? Well, in America, most people are having their savings that are not enough for their retirement. So 40% of Americans are retiring with only Social Security benefits, and 65% are not saving enough for retirement. And with the increased cost of housing, healthcare, and other types of long-term care, this problem is just getting worse. So what's the catch? The catch is it's not an all-cash sale. Whereas with a third-party transaction, you would receive all of the cash at close or nearly all of it. This would be more, I would say, around a 40% cash at close, which would come from a commercial bank. The rest of the payments come from the company over the next 3 to 5 years to the selling shareholders. So that goes to show that if you don't believe in the future cash flows of your business, the ESOP is probably not the right structure for you. Some really great benefits that we see for the companies and the employers. You see about 4 to 5% increased productivity. These companies are much less likely to disappear for any reason. And it is a very great tool for attracting and retaining employees, 4 times more effective. The employees also stay longer because the longer they stay, the longer they're vested and the greater value that they have for their shares. And because the company does not pay federal or state taxes, that extra cash can be used to pay the employees more as well. This is a sample design. A lot of it's similar to a typical 401k plan. The plan participants would vest over a 6-year period, and those shares would be allocated to their accounts each year over a 30-year plus or minus period. The employees receive this benefit based on a percent of their compensation out of the total payroll. And again, those shares are allocated each year. When the individual retires, the company would pay them out over a 5-year period. For any other type of termination, there is a 5-year waiting period, and then the employees would receive the benefit over a 5-year payout period as well. And again, these shares are valued each year, so the plan participants are able to see the value, and as they vest into the program, what that benefit would be. Quick snapshot in comparing an ESOP to a third-party sale. In a third-party sale, you will see 25 to 30% tax on the transaction. When selling to an ESOP, that taxation could be 0. The payout for a third-party transaction often includes an earnout or a clawback provision if you're selling to private equity. A sale to an ESOP is a fixed transaction where your payout is about 40% at close, followed by structured payments to the shareholders over the next 3 to 5 years, depending on the company's cash flow. Sales to a third party can be very unpredictable versus a sale to an ESOP, which is a private pathway with much easier diligence. The disruption to operations can be very material when you're selling to a third party. Whereas with an ESOP, the disruption is very minimum. In fact, the day after an ESOP is formed, the operations will continue exactly the same way as they had the day before the sale and into the future. The employee impact when selling to a third party is unknown, depending on that buyer. But when you sell to an ESOP, as we saw in an earlier slide, the impact is very positive. The likelihood and certainty of close, again, is unknown with a third party. We've worked with clients that have worked through a sale process for several years without an actual closing, versus a sale to an ESOP is 100%, and you actually choose the buyer in an ESOP transaction in selling to the ESOP trustee. The post-close involvement for a third-party sale is at the buyer's discretion. Likely there would be a 3 to 5 year contract for the selling shareholder or shareholders. For a sale to an ESOP, it's very flexible. We like to think of this almost as an off-ramp for the owners. They can take their time, they can remain with the company and entirely control it for as long as they desire. The debt structure at close for an ESOP, as we mentioned, involves a bank loan and a larger seller note component. The bank loan is the amount of funds that are received at close. The seller note would be paid off by the company over the next 3 to 5 years to the selling shareholders. For being patient shareholders, they typically earn 12 to 13% interest on their seller note, as well as those principal payments. The bank term loan we're seeing right now, pricing between 2 to 350 over SOFR. with 5 to 7 year amortization periods and no personal guarantees. Also, a line of credit, if in place, could continue or a new one would be instated. Again, there are generally no personal guarantees when we run this process with banks. This is an example of how this could be received over the 5-year period. A chunk of cash at close, followed by payments each year on the seller note principal, interest on the seller note, and a nice warrant piece that can be up to 30% of the valuation that comes once those seller notes are paid off. So again, to keep in mind, there's some very powerful seller advantages in an ESOP structure. The potential of more after tax sale proceeds by avoiding capital gains. The tax benefits for the companies themselves operating without paying federal or state taxes. The large interest and warrant 13% range on the seller notes. Again, the reward for these sellers for being patient and accepting payment over 3 to 5 years. The ability to continue managing and controlling the company indefinitely. The ability to retain the company as a tenant if the owner or selling shareholders owned the real estate prior to the transaction. The company can continue paying them rent. Much easier diligence process than a third party with a very predictable outcome. Very confidential. The ESOP buyer pays the closing costs. In this type of transaction, those costs are built into the seller note, so the costs are not incurred by the selling shareholder. And this is an opportunity to reward your employees for the hard work and contributions that they've made to your company so far. The employees are now able to have beneficial ownership in a company that they're dedicated to and worked for. And there are other special incentives for these key employees that we could discuss more on a future ESOP 201 presentation. A few screening parameters to keep in mind if you feel that you may know someone interested in a transaction. We look for EBITDA of 3 million or more. 18 employees to satisfy ERISA testing. No heir, son or daughter that may want to take over the business. Management available to operate the business, again, because the seller note component is largely dependent on the success and continued operations of the business. Confident sellers that are willing to be patient and receive their full monetization over a 3 to 5 year period. And adequate borrowing capacity. We would run the process with the banks and help find the financing, but the company would need to have borrowing capacity available. A few ideal situations that we've come across over the following years, past years. Management wanting to buy the company, but potentially not having the ability to put forth the cash. Also, that would not have the same tax advantages as an ESOP. Niche companies, potentially with customer concentrations that would have a hard time in a third-party sale transaction, would be great ESOP candidates. White-collar firms where their employees are key contributors to their success. Contractors, again, with the people being a strong component of the company's success. Small town companies, any type of corporate divorce or age disparity, we can look at the two or more shareholders and have them contribute to the ESOP at different points of time, and different percentages can be sold. A transition period for the seller, those that are patient, willing to wait that 3 to 5 year period and potentially want to remain with the business even longer, are great candidates. And those that find their legacy to be important and they don't want to see others take over their business and potentially lose that important legacy component. And that is our ESOP 101. Thank you so much for having me today.
Thank you very much, Ashley. Fantastic presentation. And again, if you think you qualify or would like to further discuss ESOPs, please send us an email at info@fiduciarypp.com, info@fiduciarypp.com. We would be more than happy to send out complimentary proposal overview of potential opportunities in ESOPs. Thank you very much, Ashley.
Thank you.